Jim Kochan, let's go around the bond world if you don't mind, and we'll start with Treasuries. Is 2.4% yield a good value right here?
It's getting toward a good value. I think that's the way I would put it. It's a lot better than 1.8, which was only 2 months ago. I think there's still one more concern in looking forward, and that is when the Federal Reserve actually announces they're going to start raising the federal funds rate. We might see that yield get to 2.6 or 2.7, but we're closer to fair value now, certainly, than we were several months ago.
What about tips? Do you like tips? Because we have seen inflation stirring with that April core CPI number.
I don't like tips, frankly. They don't yield enough. And not only that, even though inflation is beginning to perhaps, you're seeing a little bit more inflation in the United States, the way the tips are calculated, the way the returns and the principal values are calculated, there'll be very low total returns from tips, I think, during the remainder of this year. If I were to recommend tips, it would be wait until next year when we're likely to get better inflation adjustments to the tips themselves.
What about the muni market? We've seen problems stirring in Puerto Rico, Chicago, Illinois. Can they drag down the entire market? Because Chicago is a big city. We're not talking about little places in California and Alabama.
We don't think they'll drag down the entire market. In fact, well, Puerto Rico and Chicago are different problems. Puerto Rico has a serious problem with its tax base. You know, the population is shrinking, GDP is shrinking. That's not true for Illinois, that's not true for Chicago. So even though they have problems with the pensions and with their credit ratings, we don't think that the Illinois-Chicago situation is comparable to Puerto Rico. And Puerto Rico is pretty well priced into the marketplace. So yes, there are pockets of these kinds of credit problems, but overall, the demand for municipal bonds is still very strong, and it's likely to stay strong now that yields are somewhat more attractive than they were 6 months ago.
And speaking of yield, let's talk about high yield. It's come back since the energy-related sell-off in the winter. It's stabilized here. How much higher can yields go for high yield? Where's the value there?
I like the high-yield bond market on the corporate side because, as you said, those yields went up last year. This is one of the few markets that we follow in the domestic in the domestic markets where yields are higher today than they were a year ago because we had that adjustment last year. So they could go modestly higher, but during this big sell-off in Treasuries and other markets, yields on the high-yield corporate side did not increase all that much. There's good value in high yield. You want diversification. You want to avoid the weakest credits, in my view. But still, I like markets that are providing a substantial amount of interest income here, and they're hard to find. High-yield corporates is one of those markets.
And what about investment grade? We're seeing a lot of companies come to market because they want to get in while the yields are low. Even so, Apple do a deal in Japan. Tell me about good old corporates.
You're right, there's been a tremendous amount of issuance. That has pushed those yields moderately higher. I think in the triple B arena, single A to triple B credits, we're finally seeing some value again in investment grade corporates. It's been a while because in my mind those yields were simply too low. Again, they're like Treasuries. You could see those yields adjust higher over the next several weeks and months, but we're getting closer to fair value in those markets too.
All right, thanks a lot, Jim.
Thank you. Thank you for having me.
Thank you for watching The Street.